There are moments in markets that feel almost unreal, moments where the screen flashes numbers so quickly that even seasoned traders pause and ask themselves what just happened. Imagine opening the chart and seeing gold surge $120 in just 2 hours. At the same time, the dollar begins to slide, confidence starts to wobble, and suddenly the conversation everywhere becomes the same question. If gold is moving like this, is silver next? Because moves like this are not just about price, they are about psychology. They are about global confidence, and sometimes they are about the silent signals that the financial system sends long before the headlines catch up. When people hear the phrase, gold pumps $120 in 2 hours, it immediately triggers emotion. Some people feel excitement, others feel fear. Some think they missed something important. But what truly matters is not the excitement of the move. What matters is understanding why markets behave this way, what it reveals about global sentiment, and how disciplined thinkers learn from these moments instead of reacting emotionally. Gold has always occupied a unique position in human history. Long before digital currencies, long before stock exchanges, long before central banks, gold represented stability. It represented permanence. Empires rose and fell, currencies were created and destroyed, but gold remained a reference point for value across civilizations. So when gold suddenly moves with explosive speed, it is rarely just a random event. Markets are ecosystems driven by expectations, uncertainty, and capital flows. A rapid move often signals that something deeper is shifting beneath the surface. Consider the role of the dollar in global finance. The dollar functions as the backbone of international trade, reserve systems, and liquidity flows. When the dollar weakens rapidly, even temporarily, it tends to ripple across every asset class. Commodities react, bonds react, equities react, and precious metals often respond with amplified movement because they sit at the crossroads between currency confidence and long-term value preservation. Think of it like pressure building inside a sealed container. For a long period, nothing seems to happen. The system appears stable. Prices move slowly, sometimes even sideways for months, but pressure is accumulating invisibly. Then one moment arrives where the system releases that pressure all at once. The move looks dramatic on the chart, but the conditions that created it were forming quietly long before that candle appeared. That is why experienced observers do not simply stare at the number $120. Instead, they ask deeper questions. What triggered the flow of capital? What narrative changed? What fear or opportunity suddenly entered the collective mindset of institutions around the world? Because large moves in gold are often connected to three powerful forces. The first force is uncertainty. Whenever global markets begin to question stability, gold tends to attract attention. This does not mean catastrophe. It simply means that investors begin rebalancing risk. When confidence in certain assets wavers, capital seeks alternative anchors. Imagine a ship navigating through calm water. Passengers relax, conversations are casual, and no one is worried about the horizon. But the moment dark clouds appear and waves begin to rise, behavior changes. People look for safety. They secure their belongings. They pay attention to where the lifeboats are. In financial markets, gold often represents that psychological lifeboat. The second force is liquidity. Large institutions move enormous amounts of capital. Pension funds, central banks, global funds, sovereign entities. When these players adjust allocations even slightly, the effect can be dramatic. A shift of a few percentage points in a massive portfolio can translate into billions of dollars entering or exiting a market. And when that kind of capital moves quickly, the chart reflects it instantly. This is why sudden gold rallies often look like vertical explosions. They are not always caused by millions of individuals acting simultaneously. Sometimes they are the result of a handful of powerful institutions adjusting positions within minutes. The third force is narrative. Markets run on stories. The story of inflation, the story of currency stability, the story of geopolitical tension, the story of technological change. When the dominant narrative changes, prices can move faster than fundamentals appear to justify. A powerful example is how quickly sentiment shifts when confidence in a currency weakens. If the dollar begins to drop sharply, global investors immediately start reassessing exposure. Some rotate into commodities, some into foreign currencies, some into precious metals. And that is where the question of silver enters the conversation. Silver occupies a fascinating space in the financial world. Unlike gold, which is primarily viewed as a monetary asset, silver sits between two identities. It is both a precious metal and an industrial resource. It is used in electronics, solar technology, medicine, and manufacturing, while also carrying historical monetary value. Because of this dual role, silver often behaves differently from gold. Sometimes it lags behind, sometimes it moves more violently, sometimes it stays quiet while gold leads the conversation. But historically, when precious metals enter periods of strong momentum, silver tends to attract attention shortly after gold. Not because it must, but because markets begin to look for relative opportunities, correlations, and momentum patterns. Think of gold as the signal fire on the mountain. It lights first. It gets everyone's attention. And once that fire is visible, people begin scanning the surrounding hills to see what might ignite next. This does not mean that every gold rally automatically guarantees a silver surge. Markets are far too complex for simple guarantees. But it does mean that observers begin watching closely. They analyze relationships. They study volume patterns. They examine how capital flows are shifting across the broader commodity landscape. And this is where mindset becomes more important than prediction. Many people approach markets with the belief that success comes from guessing the next move correctly. But long-term thinkers approach markets differently. They focus on understanding systems, cycles, and behavior patterns rather than chasing every sudden spike. A rapid gold move can be educational in several ways. First, it reminds us that markets can move far faster than most people expect. Stability can persist for months or years, but momentum can appear in hours. This is why emotional decision-making is dangerous. If someone waits until excitement peaks, they often end up reacting instead of thinking. Second, it highlights the importance of preparation. Disciplined observers spend time studying markets when nothing exciting is happening. They analyze trends, learn historical patterns, and understand the forces that drive capital movement. So when dramatic events occur, they are not overwhelmed by them. Third, it reinforces the value of perspective. A 2-hour chart can feel explosive, but zooming out often reveals that markets move in long cycles. What appears dramatic in the moment may simply be one chapter in a much larger story. This is especially true for precious metals. Gold and silver have experienced countless cycles throughout history, periods of explosive growth, periods of long consolidation, periods of volatility that shake out weak conviction. Each cycle teaches the same lesson. Emotional reactions rarely produce wise decisions. Calm analysis almost always does. That is why education matters more than excitement. Instead of asking, how fast can something rise? A better question might be, what forces are driving this movement? Instead of asking, did I miss it? A stronger question is, what can I learn from it? Financial awareness begins with curiosity. Study how currencies interact with commodities. Study how interest rates influence capital flows. Study how geopolitical uncertainty changes investor behavior. Study historical charts not to predict the future perfectly, but to understand how human psychology repeatedly expresses itself through price movement. Because markets are not just numbers. They are reflections of collective belief. Every candle on a chart represents millions of decisions happening simultaneously, decisions made by individuals, institutions, governments, and algorithms. When those decisions align suddenly, price can move in ways that appear shocking. But beneath the surface, the move is simply the visible result of invisible forces reaching a tipping point. So when you see a headline like "Gold pumps $120 in 2 hours, dollar crashes, silver next," it should not trigger panic or blind excitement. It should trigger curiosity. What changed today? What signals did the market send? What relationships between assets are beginning to shift? And perhaps the most powerful question of all, how can moments like this improve your understanding of the financial world? Because knowledge compounds just like capital. Every time you observe markets calmly, analyze patterns, and resist emotional reactions, you strengthen a skill that becomes more valuable over time. The skill of thinking clearly when others are reacting impulsively. That skill is rare. It is also incredibly powerful. Markets will always produce dramatic headlines. Gold surges, silver drops, currencies fluctuate, crises appear and disappear. But disciplined thinkers understand that the real advantage is not speed. It is clarity. Clarity about risk, clarity about cycles, clarity about the difference between noise and signal. And when clarity replaces emotion, markets stop feeling chaotic. They start feeling like systems that can be studied, understood, and respected. So as you watch these moments unfold, gold moving rapidly, the dollar shifting direction, analysts debating whether silver might follow, remember that every major movement in financial history started with a moment like this. A moment where the charts suddenly demanded attention. A moment where curiosity became more valuable than certainty. And a moment where those who chose to learn gained something far more powerful than a single trade. They gained perspective. If you found this discussion valuable, take a moment to support the channel. Like the video, share your thoughts in the comments about what you think drives sudden market moves like this, and subscribe for more deep, calm analysis of the forces shaping gold, silver, and the global financial system. Because the more we understand these systems together, the less mysterious they become, and the more prepared we are for whatever the markets decide to do next.